looking for companies with specific competitive advantages that separate them from their peers, packaged in a fund with only about 40 names, which gets changed up every few months. Sounds awfully like an active fund, except that it's not. The VanEck Vector's Morningstar Wide Moat ETF. That's what we're talking about here. And I'm pleased to welcome Jan van Eck, CEO of Eck Associates. Great to see you.
Good to see you, Scarlet.
So let's talk a little bit about the shift from passive to active, or active to passive, excuse me. It's been happening for a long time. There's money also moving from active to quasi-active, which is kind of what you guys are. Do you see yourselves as moat, as smart beta, or quasi-active?
Definitely smart beta. I mean, I guess our whole philosophy of investing is the world is changing too fast to just stick with the market cap weight exposure as the only thing in your portfolio. So the Wide Moat Fund, as you said, is very active underneath in the companies, because these companies, while they may be high quality, have good earnings potential, sometimes they get overvalued, sometimes they get undervalued. And that quarterly rebalance is really facilitated by the ETF structure.
Okay, and it's not growth and it's not value either. That's the other thing, because in smart beta, you tend to look at these specific factors.
Right, and we've done the factor analysis, and the outperformance, because Moat is a top quartile fund against both active and passive large cap core, that does not correlate with a growth or value risk factor. Mm-hmm. It's really stock specific that drives the returns.
Moat has become a franchise too, because you've got two sequels. You've got GOAT, which is global including the US, right, and MODI, which is international excluding the US as well.
Right, right. Well, Morningstar has 200 research analysts that do the earnings projections for all these companies to enable them to qualify as a wide moat, meaning they have a competitive advantage in that towards that earnings stream. And so they have global coverage with those analysts.
All right, now Moat's holdings, as you mentioned, are changing quite often, constantly changing in fact, because the annual turnover is about 56%, which means more than half of its holdings change yearly. For the S&P 500, the annual turnover is something in the neighborhood of 3%. So could this high turnover be a blueprint for the advent of active, non-transparent ETFs that are going to make their way to the market this year?
You know, we've been an active shop. VanEck has been for over 60 years. And I think active managers are trained to be lower turnover because of the tax consequences. Mm-hmm. So for them to suddenly switch to a higher turnover way of thinking when they come in the office, I think will be a challenge initially for them. You're right, the structure completely enables that, but that's kind of a muscle that hasn't been used for a long time. So, hopefully it works out for them, but we'll see.
Do you think it could lead them astray, that temptation to be able to trade more often and to switch up the holdings?
You have to have like with anything active, as we do, you have to have a very strict investment process and a rationale for every way that you try to generate alpha or returns. And that if that's going to be a source of alpha, and as you point out, not negative alpha, mm-hmm, they have to have a discipline around it, and we'll see.
Okay, one of the themes of our show this week is, of course, ESG, and you guys have an assortment of ESG-type products like SMOG and GRNB. You also have funds from the fossil fuel era, including Coal, KOL, which is for coal producers, and CRAC for oil refiners. Talk about the audience for each of these categories.
Well, I think, so when I think about ESG, I guess a couple of overall observations. G is governance, and it's at the heart of a lot of active strategies. So the thing is with ESG, are you just trying to match the market, or are you trying to generate alpha? And I do believe there's evidence that good governance and engagement with portfolio companies generates alpha. So that's one of the big differentiators. As far as E and S, or environment and the social, we have tended to favor environmental thematic, just like you mentioned. And so environmental services was actually launched the year we started our ETF business in 2006. And so, yes, with respect to coal, you can short coal. With respect to nuclear, again, these are things that I think individual investors have their own value system, and they can put together a portfolio as they see fit.
I got to ask you about Bitcoin as well to get an update on the Bitcoin ETF approval saga. You guys filed for one, but then the SEC told everyone to withdraw their applications. Now, some analysts say the SEC's approval of an interval closed-end fund improves the odd for an eventual Bitcoin ETF. Do you agree with that take?
Eventual? Is it our lifetime? I mean, I think, I agree with some commentators. I don't see a Bitcoin ETF being approved anytime soon. So, yes, vehicles that allow QIBs or accredited investors to access it, that's fine, but still, you have tens of millions of retail Americans invested in Bitcoin with no regulatory protection.